Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Friday, February 6th. We have a busy show ahead of us today. First up, the crypto meltdown shows little signs of letting up. We will break down what's driving the sell-off and whether there is a catalyst ahead. We'll then turn to Amazon's earnings. Investors are rattled by the company's capital spending plans, a concern rippling across big tech and fueling fresh volatility in the tech sector this week. We'll also talk about the information's reporting on challenges Nvidia has had to overcome with its Blackwell chip. I'm also talking with Affirm's chief operating officer as the buy now, pay later giant crossed $1 billion in revenue for the first time. And finally, we are bringing on an AI researcher to break down OpenAI and Anthropic's latest coding tools. And we will end with this week's edition of the Editor's Cut, unpacking the SaaS apocalypse. It is a big show, so let's get right on into it. The crypto sell-off is deepening. Bitcoin is down more than 10% over the past 5 days alone. It is down over 20% this year. For more on the root causes of this rout, I want to bring on Yueqi Yang, our crypto reporter, to help us break it all down. Yueqi, welcome back to the show. It's great to have you here.
Hey, Akash.
What is going on here, Yueqi? Help us make sense of it.
So the crypto market has been on this steady decline since last October when there was this big crypto crash, and it was the biggest liquidation day in the crypto market. And really, this time, people are struggling to figure out a root cause. There's no dramatic blow up of one exchange or one market makers. At least that's not what people are hearing yet in the market. And then this sell-off really accelerated this week, especially yesterday. And now we've seen that Bitcoin has erased all of its gains since Trump was elected in 2024. And broadly, there's this sense that the Bitcoin and crypto market has lost its narrative and its ability to capture investor interest at a time when other assets like AI and even prediction markets, gold, silver, are taking more, are attracting more interest from investors.
So I know there's no one thing that has caused this in a way that there has been a root cause in past crypto winters. But let's just brainstorm here. I mean, what are some of the things that people are throwing around? Is there, is this like, is it a specific company, specific part of crypto? Is it just loss of interest? I mean, surely there must be theories.
Yeah, I think the broader narrative for crypto is not great. Like crypto historically is a really a narrative and faith-driven asset class.
Right. It's
And
a
so,
speculative asset. It's
yes.
really, it depends on what people, how confident they are in this speculative asset.
Right. And we've been through several cycles of narratives. For a long time, it's been institutions are coming, or regulatory environment is getting better. And now we've had both of these things materialized to some degree. So it feels like that the market doesn't really know what else to look forward to at this point. There's no clear catalyst that could really turn things around. And all the Bitcoin ETFs are already here in the market.
Right.
Everyone, hey, Bitcoin is mainstream now, but we're not seeing the kind of inflow people are expecting. That's why there's a struggle in the market for people to get excited again about Bitcoin.
So in a sense, I mean, this could in some ways be the worst downturn that we've seen in the last few years for crypto because of the fact that, as you said, I mean, on a regulatory front, they have everything they want, or most things that they want. They have the Bitcoin ETFs. There's been adoption from the traditional financial sector. All things are going right except for the market price, and that sounds like that has people more worried than ever before.
Yes, that's right. And I think when I talk to builders and entrepreneurs in the crypto community, there's also this feeling that crypto has been struggling to find its purpose. It seems like after years of building products, the only product that has really reached mainstream adoption to some extent is stablecoins. And that's just one part of crypto. A lot of the other promises really haven't really pan out. There's years like been talks about decentralized social media platforms, some of the gaming platforms, but those products largely have failed to gain wider adoption.
Now, how are the businesses being affected? We saw news this week from Gemini, the crypto exchange, that they're laying off some amount of their employees. We also know that Strategy reported this week. How are they being affected?
Yeah, so I think crypto platforms, exchanges, they are bracing for a downturn, and they've been through several cycles now. So Gemini announced its layoff. When I talk to market participants, it seems that people are expecting more layoffs to be happening across different companies, and this is pretty normal in the crypto industry. Every few years, you've seen these really wash out of capital and talent as well from these big platforms, and trading volume have been declining as well on a lot of these crypto exchanges. And as I mentioned before, some of these companies are adapting to the changes by pivoting somewhat away from crypto, or at least diversifying into other asset classes. A lot of the crypto exchanges are either already offering tokenized stocks or tokenized gold, tokenized silver, and really for as a way for their users to keep their capital on the platform while getting exposure to non-crypto assets.
And so this kind of leads me to the last question I have for you, and this is something we were talking yesterday on the show with David Marcus, the CEO and co-founder of Lightspark. The question I have is this affecting the interest from the traditional financial sector to leverage blockchain, to adopt digital currencies, to increasingly bridge their systems, to incorporate stablecoins and stuff like that? From the people that you're talking to, is that at risk at all, or is that still pretty strong?
I think there's a divergence between the interest in stablecoins versus interest in other crypto, and I still see a lot of developments um, being made on the stablecoin fronts. I do hear about payment companies adopting stablecoins. Stablecoin companies are still raising money, potentially getting acquisition interest. So I do think stablecoin is a longer structural change that's somewhat immune from the current market sell-off in crypto. But for the smaller tokens, the meme coins, the more speculative projects, I think they will have a hard time turning around.
Great. Well, Yueqi, I want to thank you for coming on. That is Yueqi Yang, our crypto reporter here at The Information. Amazon is expecting to spend $200 billion in capex in 2026, the company said in its quarterly results yesterday. That is up from the less than $132 billion that the company spent on capex in 2025. And crucially, it was enough to spook investors, which sold off shares of the company this morning, despite both AWS and overall revenue accelerating. To break it all down, I want to bring on Jason Helfstein, Managing Director and Head of Internet Research at Oppenheimer. Jason, welcome to the show. It's great to have you here.
Thank you.
What surprised you from Amazon's quarterly results this quarter?
Sure. While people were definitely expecting, a higher level of CapEx, I think the 200 billion guidance was surprising. I mean, probably people should have probably were thinking like 175, 180. I mean, that's basically a 50% increase is what they guided, which is, below the 76% in Meta and the 96% at Google. So you could argue they're growing CapEx by the lowest amount, but the absolute amount of spending was more than expected.
Now, I want to talk to you about what is too much capex. I mean, when you look at metrics and ways of measuring this, I mean, how do you think about what is too much?
I think the struggle is that it basically takes you 2 years. I mean, I think the company's telling people as much as 3 years to actually see that flow through to the AWS revenue. And I think investors are just struggling with that long cycle. I mean, we've gone through periods where internet companies, have been valued at 3 years, 4 years out. But with many of these companies, there's been enough earnings visibility. People can think about, 1 year out, 2 years out, earnings, free cash, etc. And you really now need to think about Amazon as in like, what does it look like in 27 or 2028? Because that's how long it will take to get that that output. And I think that's what investors are struggling with right now.
What about AWS? What did we learn about that segment's traction, and is there a risk at all that its lead is narrowing compared to the other hyperscalers?
I actually think its lead is growing. So
Okay.
what we saw in the quarter, 24% growth, a 4-point acceleration from last quarter, and in absolute dollars, they again generated more quarter-to-quarter dollars than Azure. And prior to last quarter, third quarter, Azure had actually generated more quarter-to-quarter dollars than AWS. And so that investors had a reason to be kind of concerned about AWS. But I think now you have 2 quarters of them basically growing faster in dollars quarter to quarter than Microsoft's Azure. Now, the interesting thing was the dollar increase was comparable to what Alphabet's GCP reported. And so actually you walk away and you say, right now, it feels like Google Alphabet is actually in the pole position, at least from a what do the numbers deliver now over the next few quarters of next year.
What about the marketplace business? How's that performing?
I mean, it's fine. The consumer looks healthy. They were all the key segments were up double digits. No meaningful acceleration. So I know there's a concern in the market right now about the health of the consumer, reaction to some of the jobs or job openings data. There's nothing to suggest that Amazon is not seeing very healthy growth on the consumer. They did talk about a little bit of margin drag around international and some investment, but I mean, again, I think that's pretty minor. And look, this is going to be a robotics play at some point. It's still very early, and so I think investors want to get excited about the robotics margin opportunity on the retail side, but it's too early.
How much talk was there about Trainium on the call this quarter? Last quarter, I mean, it was really all Andy Jassy wanted to talk about.
Yeah, I mean, they did talk about a bit more about it. So mentions of they're executing on what they said. So if we kind of look specifically what was incremental. Last quarter they talked about having 1 million Trainium chips due by year end. They confirmed that they got to 1.4 million. On the third quarter, they talked about kind of a mid 26 launch.
Right. I mean,
And now you're talking.
broadly, I think what's interesting, this is something that, and we've had Amazon AWS executives on the show. I mean, it really, like GCP, it is the thing that they really hope will underpin customers to really continue their traction with the cloud business, which is certainly interesting. Um, I want to ask you a little bit about the broad tech sector right now. What do you make of the reaction to tech stocks this week? Not just AWS and the Amazon and the hyperscalers. It seems to be that the whole market is coming back a little bit this morning, but tech stocks are still down. How are you thinking about it?
Sure. I mean, there's definitely been the Claude reaction, Claude bot, as far as what's the risk to SaaS businesses, and that on top of the funding concerns around AI data centers and Oracle and OpenAI, it's all been pushed together, and then you have these very large companies this week, Amazon, Google coming out with these big capex numbers on top of Meta last week, and investors are really just struggling to how to think about the return on capital and how far out you go in your model. I'll give you an example. It looks like right now the preliminary street numbers for AWS, have literally 21% growth this year, next year. That makes no sense. Okay, we're published at 30% over the next 2 years, and I could argue that those numbers could be meaningfully higher than that. So literally, you have kind of like the sell side who kind of puts out the bogey that just doesn't justify all this level of spending, and you have the kind of the professional investor base, institutional investors, kind of like looking for guidance. And really, it's like we need to get back to how do you think about like return on capital 101. Jassy specifically on the call last night said this is not experimental capital. Like this is not blue sky. They clearly see the return on this capital, but if ultimately it's going to show up in 27 or 2028, the investors just don't know how to model it. So I think like thematically, that is probably the theme of all these companies with the big spending capex this week.
So you're saying that the analysts have projected low 20% in terms of growth for AWS. You have 30% in your projections.
Correct.
Why are you so much more confident?
I mean, it's kind of math. I mean, you can kind of figure out how much revenue they can generate per gigawatt on an annual basis. They said they brought on 1.2 gigawatts in the fourth quarter versus one in the quarter before versus zero point 0.9 the quarter before that. They've talked about doubling capacity over 2 years. So that means 5 gigawatts at least next year. Now, there's definitely timing concerns, but unless you think that the revenue per gigawatt is going to fall massively, right, you can kind of just do the math. Now, it is tricky. We guess at depreciation rates. We think it depreciates over 6 years. So yes, your margins take a hit as you do this, but the street's just struggling. And so I don't know. I think you will see estimates come up probably over the next 2 weeks as folks talk to each other, talk to the companies.
The streets
But
are struggling to understand it, or what are the
I
struggling
mean, I
with
think they're
what?
struggling to understand. I mean, Amazon does not give guidance, right? None of these companies give you long-term guidance. They're saying we're going to spend X, but they're not telling you, and here is what the payback will be over this amount of time. I mean, they will say it generally takes 18 to 36 months to kind of stand up a data center. Um, 36 months is at the like longer side, I think, of what most people think. But just these are such big numbers. I think the sell side is just struggling how to put that into their models. And so, but I think again, as people mull over these numbers, as there's communication between the company and the investment community over the next few weeks, I think you'll get more comfortable that there is an ROI here. It's just people may have to look out to 2027 or 2028 on how to value the company.
Great. Well, Jason, I want to thank you for coming on. That
Thanks
is
for having
Jason
me.
Helfstein from Oppenheimer here on TITV. Nvidia is certainly the leader in AI chips, but that doesn't mean that its chips have historically worked exactly the way that every customer has wanted on the first go. A new exclusive story from The Information this morning highlights how Nvidia overcame early challenges that its customers had with the complexities of its Blackwell chip. I want to bring on our cloud and compute reporter, Anissa Gardisi, to help us break it all down. Anissa, welcome back to the show. It's great to have you here.
Thanks, Akash.
Walk me through what you and our team found in your reporting.
Yeah, sure. So I worked on this story with my colleagues Channer and Wayne, and we were really focusing on NVIDIA's Blackwell rollout because now, when Jensen Huang is speaking about NVIDIA, he's kind of giving people a preview of the Vera Rubin chips, which are going to be coming out soon. But we've been talking to lots of NVIDIA customers, some of NVIDIA's biggest buyers, and what we heard from them was that, whoa, 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 before we start talking about the next chip, we're struggling to deploy the current chip. And so this chip is called the Grace Blackwell chip. NVIDIA's vision for it was that you could connect 72 chips and then scale that up into a much larger system. And by and large, from large AI companies like OpenAI and cloud providers such as Oracle, Meta, they had a really hard time getting these up and running quickly and are kind of still in the early phases of the rollout as we approach getting Vera Rubin soon.
I would encourage everyone to go read the story because there's a lot of great detail in there about what exactly technically the challenges are, and the idea that NVIDIA wants to sell these chips really in groups of 72 chips to sell entire servers. The broader question I have for you, Anissa, though, is that, I mean, we've reported on delays that NVIDIA has had getting these Blackwell chips to customers. How has the rollout been, broadly speaking? Are things better now than they were a year ago?
I would say they're better in this current moment, but the delay that we reported on in late 2024 was really the start of a long struggle. So there was the initial delay that set things back by a couple months, and then early 2025, as customers such as Microsoft and Amazon were getting some of these chips for the first time, they weren't working properly in testing, and so some of those customers reduced their orders or said, "Hey, actually, if this is not going to work." You know, out of the box, we might want to buy more of your old chips, NVIDIA. So, now that people are getting these Blackwell chips, there are still these growing pains. But what we did find was that NVIDIA released a new chip during the Blackwell series. They went from a GB200 to a GB300. And by and large, improvements on the GB300 really did help customers get things moving faster.
I am sort of thinking about this as like the software updates that Apple comes out with a new iPhone. There's inevitable. I mean, not always, but there have been issues sometimes. Some people will say, "Well, hey, millions of people have the phone now. Guess what? It's overheating." And by the way, heating is also one of the very legitimate problems that we've reported that Nvidia was struggling with. But i- i- you know, I guess from Jensen's view, and this is what people at the company told the reporters in the story, is that this is sort of what it means to be on the bleeding edge sometimes of shipping things quickly and not knowing, what happens when you scale things so fast.
Yeah, I mean, my perspective here is that NVIDIA is still a clear leader in the space, and so they kind of and they know that, and so they can kind of ship things ahead of being completely ironed out, and customers don't have that much recourse. We did report that some cloud providers were able to negotiate discounts, and NVIDIA is also, of course, doing some renting of the chips itself. But even still, people don't have a clear scale alternative to NVIDIA chips, and so they kind of just have to go along as, things get figured out in the process. And Jensen is releasing chips at a faster cadence than he did previously. Um, so we'll see how long he keeps up with the annual chip cadence, but for right now, these large customers clearly don't have another good option. Of course, they're all thinking about it.
What do you think this tells us looking ahead to the upcoming family of chips, the Vera Rubin family? Do we have any reason to believe that the issues will be more or less pronounced than what we've reported happened with Blackwell?
What we're all hearing is that, Vera Rubin should be an easier transition. Blackwell to Vera Rubin should be easier than the Hopper to Blackwell transition. But one thing that I'm definitely going to be looking out for is how cloud providers, react, because once you get the chips from NVIDIA, you have to install them and get them running for customers to begin paying for them. And I'm very curious if some people who sort of got burned or crunched in the Blackwell rollout might take some different approaches with Vera Rubin, maybe push back some deployments and set a goal for, mid 2027 instead of trying to be first, given that, maybe if you're first and you can't get things up and running, that impacts your margins.
Right. Well, Anissa, I want to thank you for coming on. It is a fun story to watch. That is Anissa Gardizi, our cloud and compute reporter here at The Information. Buy now, pay later giant Affirm reported second quarter results, topping $1 billion in quarterly revenue for the first time. Gross merchandise volume jumped 36% year over year, a slight moderation from the pace of the prior two quarters. Joining me to discuss the results is Michael Linford, Chief Operating Officer at Affirm. Michael, welcome to TITV. It's great to have you here.
Thanks for having me.
What is driving the growth in GMV right now at Affirm?
It's a number of things in terms of the pieces that sum up, but the fundamental trend here is a consumer preference away from revolving credit accounts into better alternatives to still get the things that matter to them in a way that's it's honest and transparent and good for them.
So the company is growing and it's posting healthy growth. The stock is down 20% year to date. What do you think investors are reacting to?
You know, we've learned the hard way over 5 years of being public not to spend too much time thinking about the short term on the stock price. If you look back over the past 5 years, we've certainly seen lots of highs and lows. We're focused on building the best business, and we know that if you do that, the stock price will eventually reflect that. The things going on in this business right now are just really incredible. The past 90 days have really been a clinic in just making big leaps forward in what we're building. Everything from our new distribution opportunities with Intuit in North America to VMO2 in the UK, as well as the business that continues to just post some killer metrics, not to mention our card, which continues to be a real bright spot in the business.
Right. Talk a little bit more about the growth in the card. I mean, where is that coming from?
The card is the best way for consumers to repeat on Affirm. It gives all of the benefits of the financial product that we have built that provides certainty and control to the consumer. And we deliver it on a piece of plastic. And consumers find us at the point of sale. and then they're given an opportunity to onboard to the card, and they're taking it up in really strong numbers. The growth in the card was 160% year on year this quarter. We now have 3.7 million active card holders. And all that's done just leveraging the existing network. We're not doing anything to go out and acquire these users that's inorganic or an acquisition-based approach to it. We're literally engaging the consumers we've already seen with the better product in the card. It's been a huge driver of growth and re-engagement with consumers on the platform. And it's really cool to see the consumer's preference for these honest financial products showing up in their preference for using the Affirm card.
And so just remind us of the company's trajectory here. So it started with buy now, pay later, and now the card it's a normal credit card that we're all used to?
No, it's very different. It is a piece of plastic, and so you can walk into a store and just put your chip in there, and it's the modality feels a lot like you're using a card that you're used to, but the financial products behind it are fundamentally different. It has two modes. You can pay now with a linked bank account or with the Affirm Money account, or you can pay over time, and we turn those transactions that you are, whether you're buying a jacket in the mall, we turn that transaction into an installment loan like any other loan that we have in our portfolio. And so the consumer can walk into a transaction and understand that they have complete certainty over the cost of credit of that transaction by asking for approval before they swipe the card. The consumer knows exactly what they're going to be paying to complete that transaction. And it's fundamentally different than what a consumer does with a credit card, where you kind of swipe it and you maybe don't exactly know what's going to happen in the future. You're playing a little bit of roulette with your financial life. With our card, we give you complete certainty.
So are you taking share away from the legacy credit card companies with these products? Not just the card, but the buy now, pay later offering broadly. Is it about taking share, or is it about getting business from people who may not have otherwise been as integrated into the financial system?
I think it's definitely the former. I think if you think about the total balance of revolving debt in the United States, it's $1.3 trillion of revolving balances. It's a gigantic number, and consumers are desperate for alternatives that don't force them into this compounding and revolving treadmill that the credit card business models are built on. And they're preferring alternatives that give them certainty, control. And yeah, we are really intentional around making sure we're able to give credit to a wide set of folks. It's important to us in our mission that we're serving a wide set of consumers. But the vast majority of our consumers are people who have credit cards available to them, and they're preferring Affirm over the revolving credit accounts.
And how is the breakdown of your customers changing right now in terms of levels of income or customer profiles?
Yeah, I think a lot of people are surprised to hear just how incredibly median our consumer is at Affirm. We don't really skew heavily high income or low income. We don't skew high credit or low credit. Our consumer is very representative of the American consumer. The American consumer is pretty well employed. They're highly engaged in the economy. They're able to stay current on their obligations, and that really does reflect the same things that we see in our consumer data.
And so I want to ask you this question that came up at a dinner that I was at earlier this week. We were talking about consumer sentiment and the economy at large, and the idea of the K-shaped economy came up, and people were talking about where it's headed. Are you seeing that play out in your data at all?
No, we aren't. I think there's two things that we look at when we think about what our data says about the health of the consumer. The first thing we look at is, are they engaged? Are they out engaging in commerce, completing transactions? And as you can see, last quarter, we grew GMV 36%. It's a really strong growth rate. That's a highly engaged and active consumer. And then we look at the credit performance. Are consumers paying back on time? Are the cohorts of loans charging off at the same rates that you would have expected and consistent with prior years? And all of that is very much in line. I would hesitate to extrapolate what we experience at Affirm to the broader economy, only because our product is different. Our product has several features in it which actually engineer, we think, better outcomes for the consumer. For example, our products have a fixed payment schedule that amortizes very, very quickly. So consumers who enter into our transactions are much more likely to get out of them much more quickly than if you were revolving on your credit card. That makes these comparisons from what our product and our consumer is doing to the broader unsecured consumer asset classes a little bit hard to extrapolate. But for what we see with our consumer on our product, it's really healthy, and you don't really see those signs of the so-called K-shaped economy.
I want to ask you very quickly before you go about the intersection of AI and the financial system. We talked to a lot of founders of a lot of AI startups on this show, and I'm sure there are a lot of founders out there that are working to integrate AI into the financial system. I know there are big companies like Affirm that are doing that. But as it relates to startups and emerging technology, which pockets of AI helping the financial system are you really focused on right now? And are you guys investing in a lot?
Yeah, we're investing an incredible amount. We spent a lot of time talking about this a few quarters ago. AI is all over our business. It's first, we're a software development company, and so any of the advances that we have in AI enabled development is certainly impacting our ability to ship code quickly. Those impacts, I think, are incredible and very dynamic. Every month, the industry is making big improvements. We also have products that leverage these models in order to target better offers for consumers or optimize our merchant financing programs. And we talk about how those drive incredible and much better outcomes. The real insight there is that the quality of models just goes up everywhere. And if you can, any problem that you have, it's a math problem, it's a modeling problem, the more you can leverage these Gen AI capabilities, the better off you're going to be at sorting risk, identifying and targeting offers for consumers, and building better programs. And of course, we are in the business of building models. Everything we do at Affirm is software, and most of what we do has a model behind it. So we're really beneficiaries of the tailwinds of these just fundamentally better models.
So it sounds like for you guys, I mean, really, it's the back end of the financial system and being able to sort through risk, being able to sort through how much credit to give people, which customers are worthy of which credit. I mean, it's really all that back end calculation, which is what AI is making a difference for you right now.
Yeah, but also in what consumers are offered. And so if you're a consumer, the more that the offer presented to you fits you, the more tailored it is to your financial situation, the better off that you're going to be. You're going to have a higher probability of a successful transaction. You're going to have a higher probability of a happy path. And our models are getting better at pointing offers to consumers that are going to resonate with them. Additionally, also for the merchant side, the programs that they offer can be optimized with better modeling. And again, every part of our business has a model to it, and all of them are getting better.
And very quickly, are you hiring any less this year because of AI?
The opportunity at Affirm is just so enormous. I mentioned the $1.3 trillion of revolving debt that's out there. It's so enormous that we still need more resources, but we are seeing material improvements in productivity of our engineering team because of these tools.
Got it. Great. Well, Michael, I want to thank you for coming on. That is Michael Linford, Chief Operating Officer at Affirm here on TI TV. OpenAI and Anthropic have been dueling it out this week, not just because of of Anthropic's Super Bowl campaign that they put out, which we were all watching, but also because both companies introduced new versions of their AI coding tools. I want to bring on Nico Gruppen, head of applied research at Harvey, to share with us some of his reflections on both of these tools. Nico, welcome back to the show. It's great to have you here.
Thanks, Akash. Great to be back.
So we've got Claude Opus 4.6 and GPT 5.3 Codex, which are the best named products out there, I'm convinced. Are these tools directly competitive? I mean, let's start there.
Yeah, so maybe I can frame them. They are slightly different tools. So Opus 4.6 is what we consider sort of a general reasoning model. It's really intended to be placed within an agent harness. It is the same model you may use within a product like Claude Code for code generation, but we also use it in our product for general knowledge work tasks. Codex is more specific to code generation tasks. Again, we're beginning to see a trend of adding file system management, some more general knowledge work features onto these products. They are slightly different though on the surface.
So OpenAI is really sorry, the other way around. Opus is a little more general, but Codex is a lot more specific for coding.
Yes, that's right.
Okay. Now, so is there a discussion around which is better for coding? Is this a rivalry? I mean, how do you see it?
Yeah, it's interesting. So we're looking at this through two lenses. There's the coding lens, where there is sort of a fierce standoff between Codex and Claude Code. I personally am a Cloud Code user. I love the interface. I think what they've done with Cowork on top of that is great for folks who are iterating between files and code like I am. Codex is great for long-running sort of agentic coding tasks, right? And so if you go onto the software development floor here at Harvey or in our other offices, it's not uncommon to see engineers with, 3 or 4 Cloud Code terminals open, running tasks, and then 3 or 4 Codex jobs running in the background all at the same time, right?
Hmm. So when someone comes to you and says, which is better, what do you say to that?
Yeah, I think from my perspective, I think there's an interesting phenomenon here. So I think what we're observing from the field is there is this will happen once or twice a year, right? There's an inflection point in model capability. We see a step function improvement at how the models perform on certain tasks. I actually think the last inflection point that we saw with respect to model capability was in December of last year, Q4 of last year, and we saw Opus 4.5 and GPT 5.2
Okay.
released. But this pushes up the ecosystem as a whole because all of the other labs will scramble essentially to reach the same level of performance. With the Opus 4.6 release yesterday, I think you can see there is a little bit more juice to be squeezed in this particular flavor of model. And so if I'm taking on an analytical task, if it requires file system management, for us, this could be a lawyer working within Harvey for deal management, due diligence, potentially complex transactional tasks. My model of choice today would be Opus 4.6. That said, there are other constraints that might come into play: cost, latency, long form writing. GPT 5.2 still has a little bit of an edge, but that's sort of the breakdown from my end.
I don't know if you'll be comfortable answering the question, but do you guys at Harvey, I mean, do you have brand loyalty to Anthropic versus OpenAI in terms of the products that you use?
Yeah, I think, our responsibility, we view our responsibility as putting the best model into the product for the use cases that our customers care about. Right. So, from the perspective of the AI research team, we're going to evaluate every new model that comes out, and we are going to put the one that is best suited for a particular use case in the product. I know, what you're hinting at is very much true. We live in dynamic, sort of turbulent, volatile environment right now. It's hotly competitive, and as you sort of alluded to at the beginning, I didn't think Super Bowl ads would sort of become the town commons for this sort of discussion. So we certainly take that into account. We view both OpenAI and Anthropic as strategic partners in the long
Right.
term.
Well, because it is kind of interesting. You talked about like the model releases that are really inflection points. I mean,
Mhm.
the way that I've seen this rivalry play out over the past couple months is you either have a product release, which is really making a lot of noise and is clearly a step above. And that's when people start to re up this discussion of there's a heated rivalry. If the model releases are more incremental, then you sort of hear less about it. But then you have sort of the branding side, which is like, what are the founders saying? What are the campaigns that are being run? What are the Super Bowl ads, focused on?
Yeah.
And when that happens, you just said that maybe the 5.3 and 4.6 they may have been more incremental in terms of revisions or iterations. But now the brand discussion is so significant that everyone's like going back to, well, what are the products actually doing? I feel like that's why people are so focused on it right now.
Yeah, that's absolutely right. On the one hand, it's extremely valuable to be perceived as the AI model that is leading for consumer applications. On the other hand, it's extremely valuable to be perceived as a leading model for enterprise applications, right? And so we see positioning from both labs on this front, and you can see that in the investments that they're making for specific verticals. From our perspective, we're interested in partnering with the labs to improve the models on the capabilities and the use cases that are top of mind for us. And honestly, this sort of frenzy of activity just raises the bar for our product.
So let me ask you this: what Harvey? How old is Harvey now? The company?
Just over 3 years, maybe three
3
and a half.
years. Okay, so you guys are building this company from scratch, and you have to build all of the back end softwares that all of the other software companies have had to build. You presumably have a CRM. You have, uh, database management software. Playing out in the market right now is the idea that, or the question. can you just code your own CRM? Can you just build your own software with AI? And you have bigger companies out there saying, well, you're never going to be able to do this at scale for 10,000 people, just with a snap of a finger. You are building your company from scratch. How are you able to build your own CRMs, your own database softwares? Can you do all this with AI right now?
Yeah, so we actually did start in a unique position, and as an early application layer company, a lot of infrastructure, especially sort of infrastructure for AI, like vector databases, all of these things, evaluation, tooling, infrastructure, we self-built, right? And that's largely because a lot of it did not exist. Today, I think we're already reaching a scale where we are seeing a disparity between, from my perspective, it's really a maintenance question, not a can you do it question, right? I'm sure if you put a group of 10 engineers into a conference room together and said, build us a CRM, you could do it. But in our domain specifically, like we see the difference between enterprise grade applications and non-enterprise grade applications pretty starkly, right? For us, it comes down to things like governance, security, privacy, ethical walls, all of these sorts of things. But the same is true for other sort of large scale, what I would really consider like the infrastructure of a company, both on the technical and non-technical side.
So in other words, it sounds like you, an up fast growing startup, you are still buying all of these quote unquote old school enterprise software tools that everyone is scared is going to be replaced by AI.
Yeah, I think we'd have to go down the laundry list and check each one off. But we are building for scale and we're building enterprise grade applications. I think we're less interested in spending our research and engineering effort on rebuilding these tools.
Great. Well, Nico, I want to thank you for coming on. That is Nico Gruppen, head of applied research at Harvey, here on TITV. To close off the week, I want to bring on two of our top editors for a wide-ranging conversation on the crazy events of the past few days, not the least of which is investors' fears over large CapEx spend. To break it all down, I want to bring on Martin Pierce and Laura Mandero. Welcome back to the show to the both of you. It's great to have you here.
Hey, Akash.
Hi,
Okay,
Akash.
so Martin, I will start with you. Tech had a bit of a rough week, at least from a stock market perspective. We saw all the earnings come out. CapEx was front and center. What are your key takeaways and key questions coming out of this week in CapEx?
My key takeaways are people move in herds and they don't really think independently and they freak out. They see everyone else freaking out and they freak out. And I think um, really these big companies which are spending a fortune on CapEx, they can afford it. They've got the most to gain. And I think people who are freaking out about Google investing a lot or Amazon investing a lot are kind of missing the bigger picture.
Hmm. Laura, any takeaways from you on CapEx?
No, I mean, as Martin was pointing out, I'm not going to disagree with him here in his briefing comment.
Feel
I mean,
free to disagree with me. I'm usually wrong.
well,
only
and I
only
think
once.
as it's been said on the show, it's not, the revenue growth was very high. I mean, that's what's a little bit confounding about the stock market action. I mean, it's not confounding in the sense that there's a lot of momentum in stock markets always, and I'm sure many traders, regardless of the fundamentals, don't want to be on the other side of a wave of selling. But for the average investor, is it really smart to time the market on something like this? I wouldn't think so, because as we've been pointing out in our articles and briefings, the revenue growth at companies like Google have been pretty remarkable. So that's the other side of it.
Okay, so let's go from CapEx then to the SaaS apocalypse, which has been playing out. We were just talking about in the last segment too. So the big question is AI going to replace enterprise software? That's what every trader is thinking about. It's what everyone is selling these stocks for. I look, I have a theory on this, but Martin, where do you think this is going to play out?
God, that's a tough question. Look, this is not to sound really predictable, but this reminds me a little bit of the cord cutting debate, which, obviously cord cutting has destroyed the entertainment business. And over a period of about 10 to 15 years, it has wiped out the money that the cable channels used to make as people moved over to streaming. Now, it took a long time for that to actually happen. I mean, I was writing about that in like 2009, 2010, 11, 12. It's really taken until the last 3 or 4 years for it to become a reality, and the market didn't anticipate it quite as early as it has here. So I would say, look, I don't think we yet know which of the software companies will get hurt. I think obviously some of them will, but it's a very complicated industry. I think the market is overreacting. I definitely think if you look at some of the stocks, some are trading at very low multiples, despite the fact that they're still growing fairly well. But I do think as well, I mean, Laura was arguing earlier in the week that there will be, here, Laura, I'm stealing your thunder. Sorry to do that to you. But Laura was arguing that there might be mergers and I think that that's correct. Actually, I should let Laura talk about that.
Yeah, okay, so Laura, so which mergers are we going to see?
Well, I would just want to sort of go back to what Martin was saying about the long, drawn out process of this, because we and our reporters are really avidly trying to figure out what happens. I mean, if a stock is down 80% in a year, right? It does. There's pressure on the CEO and the board to do something, and for a big pocket of the market, this could be seen as a great buying opportunity. And for PE firms that have historically loved to buy enterprise software because of the cash flow, it's recurring revenue, you can borrow against it. This would seem to be great. And I do think we hear that sentiment. I was just talking to a bunch of late stage investors last night, and yes, they are thinking about bargains, but there's I'm getting a sense of there might be a period of paralysis because, especially when you have market gyrations like the ones we've seen in the last couple weeks, people don't really quite know what's going on. And I'm not saying that lasts forever, but that could, just like we saw after any market correction after 2022 when interest rates spiked, there's this reset in valuations, whether in the public or private markets, and the solution to that doesn't happen necessarily right away. I mean, at a certain price, I'm sure some of these software companies are going to look attractive for somebody, whether it's a stronger competitor, which leads to a merger of equals. To a financial sponsor, like a PE firm. But right now when things are selling off so hard, and there's this, uh, philosophical question out there, like, is this the end of software? Which it seems silly, but like people are asking that question. I mean, that's the other side of the debate. And these are smart people who want to make a buck, right? They want to look for that return at a certain price. So
Can I just jump
yeah.
in here on this point? The same people, or maybe not the same people, but don't forget there's been all these people over the last 5 years claiming that crypto is going to take over the world. Well, so far it hasn't really, has it? We haven't really seen very much of a use case for that. And now this week, crypto is selling off. So I think we have to be careful before we believe some of these, the hypesters who claim, oh, this new technology is going to transform everything. I mean, it does sometimes, but not always.
I don't know the answer to that question, and I'm certainly not like validating it. I mean, look, we are all in the news business, and we write about things that happen. One
I
sort
like
of short term
I like
outcome.
to actually predict things, Laura. That's
Well,
different.
one possibility for us is that things sort of stay stuck a little bit, right? Like there is this big catalyst to something happening. The stock market moves, and so maybe companies that look too expensive 2 months ago or 6 months ago now look very affordable. Their market cap is $2 billion. Like that makes it much more affordable than it could have been. But if the board is or the PE firm is uneasy about like kind of the ultimate direction, maybe that stalls things. I don't think they stay stalled forever. I mean, I think after every one of these market corrections, and we just saw that after the low interest period, it took a while for the private capital markets, the private funded startups for those valuations to kind of get to the level that investors were willing to put more money in. But it didn't happen. I mean, we were on that story, from day one, and
Right.
it's actually a slow development that takes place over. I mean, it's still taking place, right? Like the Brex, we saw that takeover, which was sort of a valuation reset, and so. As Martin is saying with cord cutting, this could take place over several years, right? Like the story doesn't like get resolved in the next 2
Right. It's
months.
just that the markets move much quicker now than
And
they did.
it will calm down, and then things will sort of stabilize a bit, and then, you know, then there'll be one more of these in a year or two, and it's just gonna take a whole long
Well,
time.
I mean, and
Thing
this
I
is what's
would
all these when the AI companies go public, inevitably, whatever, this year we know that the big companies are looking to go public, but all these application layer companies, I mean, maybe there will be a wave of
But
the
don't
AI.
forget, hang on a second. This AI stuff, let's just be real. We don't yet know whether any of these AI guys can actually make any money. The only people who make money out of AI right now is Nvidia. So we are still. Will OpenAI ever make any money? Who knows, right? And
Right? Will that prevent them from going public though? I
no,
mean,
what will
this is
happen is they will go public. Investors will be like, "Oh my God, this company is losing a boatload of money," and then
So in that
like
scenario, I think
Sam
that
will
could.
be like, "Oh, it'll be fine. It'll be fine." In 5 years' time, you're still losing a boatload. Then he'll be fine. So,
I mean,
okay.
in that I'm very, very curious about it because, we've reported as much as we can about the financial activities and projections of these companies, but it's just a tiny bit of what you'd have with a public company. We don't really understand some of it, and um, I agree. When these companies eventually go public, investors are going to get a much closer look, and it may be they may see like much more volatility or customer concentration risk, which we're already sort of hearing whispers of, than investors really like. I mean, in theory, that could make some of these boring software companies look,
Look good. Yeah, they look
great.
really
exactly.
good. Yeah.
Yeah. So
So in other words, the SaaS companies just want the AI companies to go public so that they have some legs to stand on.
I
They
mean,
could,
maybe.
yeah.
I don't know. I mean, I don't,
Well, having a bottom line is good. Okay, so that's always good.
yeah. I mean, there's, I mean, I think if I think also with these software companies, the ones that are not showing very strong growth and and earnings, but the growth is actually stalling, which Akash, there's plenty of the kind of flatlining software companies, and this was happening even really before AI became this big bogeyman.
Right.
I don't see like why an investor would choose that. You would just go to the cream of the crop
Right.
for SaaS. So.
Great. Well, I want to thank you both for coming on.
are
That
we
is
going
Laura.
to debate forward deployed engineers?
Okay, fine. Okay, fine. We'll do it. We'll do it. We'll do it quickly. Okay. Just for context, okay, for listeners and viewers, there was a debate in the office earlier this week
I was
between.
actually at home. I was calling Laura
All right.
late
So
at night.
Martin doesn't like the term forward deployed engineer, and Laura says what? It's okay?
Well,
She
look,
did defend it. Come on, Laura, defend it.
I defended the use in this story. Now, for listeners who are not so in the weeds, what this refers to is a type of particular
Consultant.
engineer.
It's a consultant.
Right.
It's a
Somebody
consultant.
engineer goes in,
But
helps you
that's a
implement the
boring
AI
term.
software.
That's
It's
a
what the
boring term.
consulting.
We have to give them this ridiculous term.
Right. The
Look,
consulting
we
firms.
didn't do it. It's Palantir, which
It's fine.
likes, has, employs people who used to work in the military. They have co-opted a lot of military terms, which is something that happens in journalism and language in general. We use terms out of sports and military, and I particularly don't like that because I think it's jargony. Deploys, means that.
Oh,
But
you don't
you were
like it.
okay. But
I
you were
don't know.
okay using it in the
Akash,
store.
can I just say
I
that
was-
Laura is now changing her tune?
I was okay using it because I think in this, you know, tech labor market, I should say, not general labor market, it means something in particular. And I think there is a bit of a race. I mean, I would not die on this hill, I would say, but I do think
Well, you
that
change your tune. You change your tune, so I think
I
you
thought it was
proved that.
appropriate for this story because I think the term consultant means something different to most people, and it does not
Yeah.
relay what forward deployed engineers has meant with, the AI startups and the big AI startups like Anthropic and OpenAI, and the small ones like Distill that are building their model around hiring these highly technical consultants or sales friendly engineers, whatever way you want to call them, and
Yeah.
putting them in house at these companies. And I think it means a particular thing. And I think there's some competition here because I think the companies, like OpenAI, are realizing if they really want to get the large corporations, this enterprise wallet, then they need to put people on the ground there, and that's an expense, right? Like that's not just like go into a website and set up your API calls. This is like you're employing people. This is consultancy, and that means, a different kind of cost, in my opinion. So, I think there is interest in that topic, and is that really what like you're going to need? And it says something about the I don't know, ability to adopt AI. I think when you have to have these
Well,
kinds of
look,
people.
Martin. I mean, look, Martin. You've been on the show here. You've said AI is going to take all the jobs. What are people going to do? This is what people are doing. I mean, I think this is.
Coming up with stupid terms to describe their
But it's it's a revised job description. It's a forward thinking job description. Look, at some point, I'm sure maybe you will use it in a briefing. We'll see.
I am
I don't.
never going to use it.
Got it. Okay. Well, when you do, then I look forward to bringing you back on and telling you. Okay. Thanks for coming on. That is Martin Pierce, our co-executive editor, and Laura Mandera, our managing editor here at The Information. Well, that does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank you all for tuning in. We really do appreciate your viewership. I'm already excited for our next show on Monday. Have a great rest of your Friday and have a great weekend. Bye-bye for now.